So we're going to work on our governmental journal entries, start getting some experience with them. So we have a very simple county that just has cash and no liabilities, and so cash and fund balance are the entire balance sheet. So starting off very simple. And then we have activity for the year, and the first thing they have is a budget. And so they actually book the budget to their general ledger. The budget is very serious in a governmental agency because they don't have the authority to spend more than that. And so they actually journalize it. At the end of the year, they reverse the budget exactly as they put it in. So when we talk about the closing entries in part 2 down here, this budget entry that we're going to set up will be just perfectly reversed when we close. Okay, so let's go ahead and do A. So the estimated revenues, they're put in as a debit, and I think you can think about them a little bit as a receivable, if that would help you to sort of think about that. I'll go ahead and put these in here. You don't have to watch me type. Hang on. All right, so you've got the estimated revenues in here, and then there's other revenues coming in, other sources of financing. And so that's very different in governmental, that revenues for them are not something they've earned. They're cash inflows from grants, from other governmental units, or from taxing the citizenry. And so these are both sort of receivables, if you will. And then the appropriations are the things they expect to pay out, expenditures. And so we have new terminology, right? We have brand new vocabulary. We're going to call those appropriations. Those are expected outflows. And when the expected outflows are greater than the expected inflows, or the inflows are greater than the expected outflows, the difference goes to fund balance, either debit or credit, depending on which one is bigger. So here the appropriations are larger, and so it's going to be a reduction to the fund balance, a debit to the equity kind of account that fund balance is. Fund balance, nobody owns the governmental unit, they don't really have equity, but fund balance is the net assets less liabilities. So some organizations, some governmental units are not allowed to have a difference. They have to have a balanced budget. But this particular county, that's their budget for the year. Okay, so that's their journal entry to record the budget. Okay, what's next? Now they've got property tax bills that they've sent out. They estimate that 50,000 of those will not get collected. And then they have collections during the year. So let's first set up when they send out the tax bills, and then let's do the collections. So we set up a property tax receivable for the bills we've sent out. We record revenue only for the part we expect to collect, and then the difference is the estimated for uncollectible taxes. That is a contra account to receivables, very similar to the allowance for uncollectible accounts or the allowance for bad debts as a contra account to accounts receivable in a for-profit organization. So that is similar. At the end of the period, you'll review that estimate for uncollected taxes, and you may have to adjust it. And so that we'll watch for that closer to the end of the period. Okay, now let's collect. So this looks like what you would expect, a debit to cash and credit to property taxes receivable. So that one is closer to what you are used to seeing. All right, let's try C. General expenditures for salaries, wages, and supplies are paid in cash. So here the debit is to an account called expenditures rather than expenses. And so slightly different vocabulary, and the credit to cash. So that's pretty close to what you might have expected. All right, what about D? The general fund issues general obligation bonds at par, receiving $120,000 in cash. Now, if you remember from the prior class activity, when you issue debt in fund accounting, you actually don't record the debt. You record the incoming cash, and then the other side, do you remember what it was? You record it as a source of revenue. So that's very different to what you're used to with accrual accounting. And that takes a little while to get used to. All right, and then they bought some equipment. So what do you think that's going to look like? So unlike for profit, where items that have future value are recorded as assets, here equipment is just another expenditure. And so you would have the expenditure and the credit to cash. All right, now it's the end of the period, and they are estimating, given where they are now, that 80% of the uncollected taxes at year end won't ever be received. So let's do a little T account and see what that's going to be. So we should call it property taxes receivable. And there was no beginning, but then we sent out some bills. We collected. Okay, so we sent out those bills and we collected that. So right now, accounts property taxes receivable is $70,000. So 80% is estimated to be uncollectible. So what was our original estimate? Our original estimate was $50,000. So we need to increase our estimate by how much? Another 6, right? Okay, let's do that now. So we take it out of revenue and we increase the estimate, the contra count, the estimate for uncollected taxes. So now it's at 56. It was originally at 50,000 and we added another 6,000 to it. So now it agrees to what they think they will not collect. So that's requirement number 1. Requirement number 2 is the closing entry. So what is it we need to close? Well, the first thing we need to close is the entire budget. So that's this entire entry A. And then we need to close out revenues and expenses, temporary accounts. All right, so what's a temporary account? Well, the accounts receivable is not a temporary account, that's an asset. Estimate for, that's a contra asset. Revenue, that's going to get closed out. Cash is an asset, not going to get closed out. Property taxes receivable, not going to get closed out. Expenditures, yes, going to get closed out. Cash, no. Cash, no. Other revenue sources, yes. More revenue, going to get closed out. Expenditures, yes, going to get closed out. Cash, no, not going to get closed out. Property tax revenue, yes. Estimate for uncollectibles, a contra receivable, not going to get closed out. So it's important in figuring out what to close out to be able to identify what's a balance sheet item and what's a statement of activities item. We don't really even call it an income statement with governmental accounting. So with the new terminology, it may not be obvious. So it takes a little bit of practice to do that. Okay, so let's do our closing entry. All right, so let's close out property tax revenues. So we have this minus that. All right, let's close out other financing sources. Fund balance unassigned is going to be the plug figure. And let's close out expenditures. So let's see, what expenditures did we have? Okay. Now let's do the net. So the revenue and the expenses were not equal. You had revenue of $1,214,000, but more expenditures, so there was a debit to the fund balance for the year. Originally, we had budgeted for a $5,000 shortfall. Looks like they had an actual shortfall of $14,000. Now let's reverse the original budget. Notice how this is identical to the A entry, just backwards. No change to it. All right, so now you're starting to get some experience with working with these new account names and unusual unusual entries like booking the budget and then reversing the budget and so forth. Okay, keep going.